I guess we should start it up. We're here. Welcome, everyone. Really happy everyone could join us today. A lot of people from around the world. Thank you to our hosts at Resourcing Tomorrow for organizing this event and for today's panel. I'm Shea Small. As was said, I co-lead our M&A group and our mining group at McCarthy Tétrault, based in Toronto and London, and a leading law firm in the mining sector. Today, I'm honored to be here to lead this esteemed panel on M&A. We're planning for an engaging conversation on how the current, confluence of events may impact M&A. In particular, we have events like just writing down all the things that we're thinking about as we're looking at deals these days. Increased demand driven by the energy transition economy, the growing importance of supply chains, the difficulty of inorganic growth and development, geopolitical competition, and the advent of government capital and participation in mining investment, which in the last year has been quite prolific and something that we really haven't seen in a long time. I'd like to start just by quickly introducing our panelists. Starting at the far end, we have Karina Danilyuk, Global Head Mining and Metals at Rothschild and Company, based here in London. Next to Karina is David Baker, Chief Investment Officer at Elemental Royalty, also based here in London. Next to David, Sunny Shah, based in London. He's with the investment team leader, private equity for resource capital funds. Besides Sunny is Spencer Cole, until last month was Chief Financial and Development Officer of Xanadu Mines. And to my immediate left, Mark Gupta, based in Toronto, Senior Vice President, Corporate Development and Strategy at Hudbay Minerals. So thank you everyone for joining today. The format today we're going to do are a bunch of questions that we've talked about in advance. Each panelist is going to lead one of the questions, and then we'll have other panelists jump in as well as need be. And then if we have time at the end, we'll open it up to Q&A. So with that, first question I'm going to direct David to you to respond to initially, and that is, the mining industry continues to see a wave of consolidations, particularly in the gold sector and among royalty companies. How do you see this trend playing out, and what are the implications for future M&A?
Thanks, Shea. Yeah, it's a great question and quite, open-ended. But it is a bit of a paradox because we have, and this is going to be very, gold and a bit of copper theme because that's sort of what we focus on as a group. But we are in a world where capital markets are stronger probably than they have been in the last decade. Share prices are strong. So you would think that would look for more organic growth, more growth with the drill bit, to try and capture the outsized returns there. But we're actually in a world where you have that confluence of high metal prices, strong capital markets, and a wave of M&A. So I think it's a really interesting time to be in the sector. We're also seeing it come from both ways as well. So we're looking at a lot of growth from mid-tiers and new entrants in the space. So we saw most recently Barrick selling Tongon to a group of Ivorian financiers, which is sort of a really interesting time to be in the sector, funded by a private equity group. But then you're also seeing that rationalization and consolidation of portfolios with the majors. Endeavour Mining's always been very good at selling non-core assets, but there's been some very high-profile divestments as well. So there is that sort of energy and that momentum in that sector that's allowing M&A to take place, even when you'd expect growth to really be coming at this point in the cycle through exploration and drilling while capital is available, because that's not always the case. Look, from a royalty and streaming perspective, M&A and growth is our business by definition. So economies of scale are real, access to capital is real. We did a $1 billion M&A transaction this year to form Elemental Royalty Corp with our merger with EMX. There's been 10 transactions in the sub-$1 billion royalty space, so there's already been some consolidation. But you're starting to see that at you're seeing this at the top end as well, with Sandstorm being acquired by Royal Gold just recently to make sure there's definitely a big 3, not a big 5 or 6. So I think, just by its nature in the royalty sector, we'll definitely look to see more growth through M&A, whether that's portfolios or acquisitions of other companies. Look, where does it go? I think certainly at the moment, I definitely see this M&A trend to continue. It's the easiest way to take advantage of high metals prices, and there's certainly some certainty in buying existing processes rather than trying to have to build it yourself, which is increasingly going to take time and longer than it's ever been to permit. I think what will be most interesting is who's doing that and where it's coming from. We haven't spoken about Chinese entrants into the space who probably can't look at the US or Canada or Australia, so you used to look at them in more Africa and South America. But look, I'd say at the moment I definitely see this wave of M&A continuing in the space.
That's great, thanks David. And Sunny, how do you see this trend playing out as well from your perspective in private equity?
Yeah, I think to complement what David said, M&A in the sector is continuing. I think the sector continues to be extremely fragmented, at different levels. I mean, you've got a whole host of, junior miners, and then you've got a bigger handful of mid-tier miners, and then you've got the large caps who are consolidating themselves, and that, I think, trickles down. So I think that's fundamentally a setup of our industry, that it is fragmented and it's relatively small when you compare it to other industries and the market caps of other industries. The largest in our space are still relatively small compared to the largest healthcare company or the largest tech company, etc. So I think consolidation will continue. I think the other theme is that's relevant in our sector is, and it comes to the growth, when you are growing, you have different ways to grow. So you have obviously growing organically, but there hasn't been that much organic spend from the industry over the last decade or more. And so in order to grow, you are having to explore M&A as an option, whether it be acquiring junior prospects or letting someone else, bring a mine into production, which is often what we do, and you get one of the other majors or mid-caps to then buy a producing asset. The risk-reward is slightly different, and sometimes takes a different skill set to build an operation into steady production than to actually operate one for the long period. So I do see the trend continuing, obviously different at different levels, but definitely a trend we're going to see more of.
Thanks, Sunny. And maybe just open it up to the other panelists just on this topic, but a related point, just hearing all this. What do you think the role, when we think of this consolidation, what do you see the role of activists being? Like we've seen Elliott take some recent positions, for example, in Barrick and so on. Do you see that being a continuing trend across a range of sectors? Like is the mining sector gaining more, I don't know what the word I'm looking for is, but is it becoming higher profile that the activists are now focusing on it, seeing there an opportunity to push consolidation and other types of activity? I don't know if anyone wants to touch that one.
Maybe I'll jump in. I think because it is becoming higher profile, I think we will see more activist activity, but the activist activity has seen somewhat mixed success. Okay, so obviously Elliott has done well out of a couple of situations, but at the same time, Palliser and Rio tried to push them to re-domicile into Australia, collapsed the DLC, and have clearly failed. So I think mixed success will drive some caution, but just the fact that this is an industry that is increasingly in the headlines, and at least on paper doesn't appear to be achieving the types of valuations that you would expect in a sector that is front and center, that you'll see more activist activity.
As someone who's been a target of an activist campaign in the past, I would say what makes this industry more challenging for activist campaigns is simply the time it takes for those campaigns to go through and what can happen to commodity prices during that cycle. So unlike sort of traditional businesses where the cash flows are relatively stable and there's some real either sum of parts analysis or M&A that can drive value, here if you've got a 6-month or 12-month activist campaign, the commodity price could be completely different at the start versus the end. And so much of it is driven by shareholder sentiment and share price performance that if the activist gets the call either wrong from a commodity standpoint, even if their thesis plays out from the actual company, they can have a real unintended consequence for the output.
Thanks, Mark. Maybe switching to another question for the group, and I'm Karina, I'm going to start with you. What do we think about the recent Teck Anglo proposed merger? What does it tell us about the state of mining, state of exploration and development, and particularly in the copper industry?
Sure. So the deal is obviously driven by copper. I don't think I'm really discovering anything here. I think that bit is pretty clear. And if you look at the way that the transaction's been positioned to the market, 50% of the initial presentation, the joint presentation by the two companies, was focused on copper. It's about copper growth. It's about all of the world-class assets that will sit in the pro forma portfolio. There's emphasis on 70% exposure to copper, much closer to copper pure plays on a pro forma basis than Anglo on a standalone basis would have been. It propels this company into the fourth slot by production globally after Codelco, BHP, Freeport, and very much America's focused copper production. It also has a unique attribute in the mining industry, which is there are actual operating synergies. You don't often see that in mining sector M&A transactions. And again, the synergies are mostly focused on the copper asset base. So when you look at the themes coming out of that deal, top 5 copper producer, value creations from mostly copper synergies, and premier copper growth. And it was, I think, after initial hiccups and sort of some rumblings by the Teck shareholders about lack of premium, it has been actually very well received by the market. But implications of this, I think it's worthwhile going back in history of the copper industry a little bit to 2013, 2016 in order to understand the implications. And at the time, if you recall, copper was on a downward trajectory, trading at about $2 a pound or so. We've come out of the super cycle. The Chinese infrastructure build out had slowed down substantially. And we all heard the same story. There's a deficit coming because there's no new supply, there's no sufficient investment, the grades are trending downwards, the marginal costs are going up, which of course should drive prices. There's been no technological improvement since SXCW in the 1980s. So all of that pointed to an increase in copper price, which didn't materialize at the time because the demand side of it simply wasn't there. So the trajectory continued downwards. That significantly stretched balance sheets of copper producers. And as a consequence of that, what happened is what I refer to as the great garage sale of 2013, 2016, when a number of copper assets owned by the majors were sold in the name of portfolio optimization, but really it was to shore up highly stretched balance sheets. So if you recall at the time, Anglo sold Anglo Norte, Timok was sold, Las Bambas was sold for a different reason. And that resulted in a couple of things. That resulted in the creation of new emerging mid-tier players like the Capstones of the world that were sort of built around those acquisitions. And it resulted in some of the Chinese players kind of quietly building very substantial copper portfolios. And I'm talking about CMOC and Zijin and Minmetals on the back of all of those asset sales. And the majors themselves shrunk their copper portfolios. So that then now brings us to today. So for the majors, particularly for the diversifieds, copper is now a much, much smaller percent of EBITDA contribution than the bulks, like iron ore, for example. But it is the most exciting. It's the one that has most growth fundamentals. It's the one that has story behind it. And as a consequence of that, all of the diversifieds are trying to figure out an angle to get more copper into their portfolios, which brings us to the Anglo-Teck deal. The issue is that the relative valuations have diverged very, very dramatically. So when I compare diversifieds versus pure play copper producers, the relative valuations differ by about 2 turns of EBITDA, which is massive, which makes pure play copper sort of unaffordable for the diversified producers. And I'll make one caveat to that, which is that A year ago, the gold majors would have been major competition for a transaction like this. I think today it would be awfully difficult for a gold-focused major to make the argument to their shareholder base and to the market that they're diversifying into copper, just given where gold prices are today. But do I see substantial new M&A coming from, this large-scale M&A coming from diversified majors in order to build up their copper portfolios? I think it would be awfully difficult. So they're in a pickle in the sense that organic growth is slow and long and difficult and either geopolitically fraught or stakeholder fraught. Witness resolution, which has been stuck in permitting sort of morass for the better part of the past decade. So organic growth is difficult. Inorganic growth is expensive. So while everybody is sort of running the slide ruler over one another, I think significant moves are going to be difficult to make. So what does a major do? I mean, either it's a once-in-a-life-cycle shot, like the Anglo-Teck transaction, or they build out their organic portfolio very painstakingly and slowly. When you build it in a sort of frontier jurisdiction, because that's where the premier tier 1 assets are, which brings with it geopolitical challenges.
Thanks, Karina. I think I actually learned some stuff on that as well. I wrote down great garage sale as one of them, but yeah. Mark, over to you. Obviously, you're in the sector, copper in particular. Where do you see this going? And in particular, commenting a bit on Karina's observations on how we got to where we are and where this could go.
Yeah, completely agree with Karina's perspective. I think from our perspective in the space, we often look at the buy versus build question, and Anglo's obviously done that on a much grander scale. You look at the last big copper mine, it's probably QB2. It was built for $10 billion plus, and kind of $40,000 of installed capacity, depending on your view on annual production. You can buy Teck, for instance, for a much lower cost and much less risk because it's already in production, notwithstanding the challenges of QB2. So I think the buy versus build is a real question that certainly the mid-tiers are asking, and as are the majors. There's just a lot less opportunity in the super major space. The valuation point is really important. I mean, I was looking at this last night in advance of the discussion today. The BHPs, Rios, Vales, they're trading at 5 or 6 times EBITDA. Antofagasta trading at 10 times EBITDA, and to the extreme, Southern Copper trading at 15 times. And so you're exactly right. I think the majors are saying, how do I get 2 or 3 times valuation for the same dollar of EBITDA, given I have this very large, profitable copper business, albeit stuck within effectively an iron ore company. So I don't think they're at the point yet where they're thinking about splitting that business off, although I'm sure bankers are pitching that every day. But they're thinking about creative ways to unlock that value. But it's not an easy discussion. I think the route of actually building a project is much more challenging because, as Karina points out, you're in a frontier jurisdiction, whether that's at 5,000 meters, perhaps in Argentina or in more challenging parts in Asia or Africa. And the risk to actually developing those projects, it's very, very challenging. So I even think of the incentive price. Woodmac's incentive price today is about $4.25 a pound for new projects. We're sitting at $1 a pound above that, and you're not seeing this whole wave of copper supply coming on. And either companies aren't believing in the spot price, which I don't think so, or there's just not enough organic projects in the pipeline to actually be developed. So I think M&A is the natural progression, and clearly Anglo went through all those permutations to come up with the Anglo-Teck deal.
Thanks, Mark. I mean, the one observation, I go back to how, Karina, you kind of ended it on copper in particular, is it might make sense to do M&A in copper, but there's only so many opportunities. So that's the fundamental problem. That's the mismatch. Let's switch gears a little bit. Sonny, I'm going to come to you. In the first, the question is, what are the opportunities for private capital to invest in the mining sector, whether through equity, debt, royalties, and how can partnerships with government assist with supporting those investments? And we're seeing, quite a few recent announced partnerships with the U.S. government or IFC or others. What's your take on all of that?
Yeah, it's great. I think in terms of opportunities, there is a significant amount of opportunities. You know, our sector, I still believe, is truly undercapitalized. And so whilst there is growing number of private capital vehicles or quasi-government vehicles deploying into the space, I still think it's a fraction of what the industry actually needs to deliver upon the demand that is coming. And so that presents itself, you know, a wide range of opportunities. That being said, you know, you have to be selective on different jurisdictions, different commodities, etc. And that goes across the capital structure. So I think because of particularly in growth projects, the capital requirements are quite large, right? I don't think under $1 billion you can do anything now in mining, or you'll struggle to. Again, generalizing a little bit across commodities, but that requires a huge amount of support, whether it be from, you know, equity providers, debt providers, quasi-debt providers, streaming and royalty companies. But host governments have always been an important part in the industry, whether it be through the stability of the regime, their own royalty or government royalties, but now promoting, you know, more supply. I think this is driven a little bit by the geopolitics of the West and the East, which I think isn't going to die down anytime soon. But what it is doing, which is good, is putting our industry at the front headlines. It's getting more attention, and so we do get a lot more assistance from these government organizations, whether it be through direct investment, political risk insurance when you're going into more frontier directions, particularly the US in the you know, DRC all the way to Angola now with their investment in the Lobito corridor. You know, that was, some of those areas may have been difficult for foreign capital before. With that support, you know, you can take a different risk-reward angle to that. So I think all of that is going to be helpful to deploy in the sector. And I think it's going to continue for a while, given where we are in geopolitics.
Thanks, Sonny. David, how do you see that playing out, particularly, you know, from your observation with a, you know, a royalty and streaming company? You know, maybe a slightly different angle on that.
Yeah, I think it's the advantage that the private equity and private capital guys have is the ability to invest through the cap structure. So whether that's debt, whether that's equity, something mezzanine in the middle, I guess with that also comes control, because you want to know exactly where your money's coming from and then how it's returned to LPs. I think we have a different approach. There's certainly a well-trodden path to, I guess, indirectly support the private equity guys through acquisitions of royalties and portfolios that they hold, a very well-trodden model, allowing them to prove their business case, get money back to LPs, and then rinse, repeat through successive funds. But then I think you're also seeing all the royalty and streaming companies looking at that and going, well, actually, how do we compete here as well? So, you know, seeing royalty and streaming companies, ourselves included, jumping into the equity, for example, which obviously supports our underlying investment. But I guess we are a very different business in that we aren't a fund. We don't have any set defined deployment periods and then realization events. So we can definitely take a longer term, lower cost of capital business, but I guess that has to be a perpetual element to that too. So that comes with the downside. It's sort of debt you never pay back.
Thanks, David. I'm going to switch again a little bit over to you, Mark, on joint ventures. So can you comment on how joint ventures and offtake are being used to secure supply and as a tool for financing and M&A? And I feel like I'm giving you a softball pitch here, because you just did one of the best joint venture deals out there in the market in a while. So maybe lead us through that.
We can do a shameless plug. That's great. So earlier this year, Hudbay brought in Mitsubishi Corporation as a 30% joint venture partner at our Copper Web project in Arizona. That's a PFS level project, produces roughly 100,000 tons of copper initially for 20 years with the potential to expand kind of beyond 50 years. We did that for a variety of reasons, and I think a lot of these themes kind of aren't Hudbay specific, they're kind of throughout the industry. There's a validation aspect to that. So not just from a mid-tier company, even from the majors, having a second set of eyes on your project. You get experts across the spectrum from resource up to mining and metallurgy. So it's validating when another company of that scale wants to come in and invest. But I think fundamentally it's a cost of capital arbitrage that's really driving a lot of the interest, at least from our perspective. So we're a circa $10 billion company. Mitsubishi's a $100 billion company. They necessarily have a lower cost of capital. Park views on copper price and everything else aside, just the business itself is a lower cost business. And so we're able to arbitrage or leverage their cost of capital to improve the valuation of the project. Our IRR on the project went from about 20%, and through the investment and some leverage of the asset, will now be over 90% for the same project. So Hudbay's equity IRR increased several fold because of that. The offtake was a component as well, which was important, as you mentioned. So Mitsubishi, for example, they've got one of the largest trading businesses in the United States for both copper concentrate and copper cathode. So they're entitled to their 30% share of the offtake. That's going to feed into that trading business. So that's another level where they can generate some incremental profit, which maybe a mid-sized company wouldn't have the same scale, which again goes back into the valuation. But I think the control and the supply of copper concentrate, and particularly copper cathode, has never been more important from a supply chain perspective. As the world potentially enters into a wartime economy and East versus West kind of gets shut down in terms of supply chain, what we're seeing is both the US government and the Canadian government really opening their eyes to where are the critical minerals, including copper, coming from. Mm-hmm. And it's clear China has all of the downstream processing capacity and lacks the resources, and the Western world has a lot of the resources but lacks processing capacity. China is, in some respects, hedging their bets by securing supply in Africa and other parts of the world. And I think just now the Western world is starting to really put a focus on processing and downstream metal production. And so offtake and supply chains feeds right into that.
Yeah, we're definitely, just speaking as an outside advisor, we see offtake now being a large part of many of the deals we do, and it's a key factor. Spencer, over to you. What are you seeing both on the use of JVs as an M&A tool, and the rise of offtake, I would call it. Like, it's always been there, but it seems to be a key part now with the world trying to secure supply chains, that it's a key part of every deal.
Absolutely. When we look at joint ventures, I guess what I'll add to what Marcus said is I'm going to add it from a 1.5 orders of magnitude smaller company. When you're in a junior and you're looking at, well, how do I fund? How do I convince the market that I can take this project forward? Those are really key tools. A joint venture can prove all of a sudden that this is something that can be funded if you're sitting with $1 billion investment and you're $100 million market cap. Mm-hmm. But and then of course you're also at that scale dealing with earn-ins from companies that just want a free option as you de-risk your project and as you grow. I think the unique thing, as you mentioned, is that you used to not look as much, or we used to not look as much towards royalty and streaming and that sort of thing as funding options and offtake the way that we do now. We used to have to search that out, and it's kind of an unusual way to look at the project. But now you're peppered with contacts from people that want to do those sort of deals with you. So it becomes instead of niche, it becomes a real viable option to fund and take a project forward.
Thanks, Spencer. One of the themes that's come through sort of in all the questions we've talked about today is this geopolitical competition and securing supply and what's going on in the world. So Spencer, I'm going to come back to you on this topic and just say, let's discuss the implications of that geopolitical competition for resources that's occurring particularly in Africa, Latin America, Asia, and what effect is that having on M&A?
I guess, again, speaking from my recent perspective in Xanadu, and for background, Xanadu was recently taken out in a cash deal by an Asian company, and this topic really comes through all the way through that story. So you're looking at supply chain diversification, you're looking at resource nationalism, starting to arise from this competition that's happening. And from our perspective, what we saw in M&A is that we saw you saw people are looking at this from a strategic perspective. They're echoing government policy in the way they're looking at M&A more. It's not as much just a purely commercial discussion. You're also seeing risk tolerances being expanded from where they've traditionally been, whether it be a jurisdiction that previously wouldn't touch, or it's or again, the commercial requirements perhaps are loosened on what you'll invest. Also seeing governments scrutinize deals in a way that they didn't in the past, and use of critical minerals lists to affect who can invest. Also looking to take a bigger piece of the pie. And I guess finally, this funnels competition for assets into fewer jurisdictions, and specifically the places you discussed, Africa, Asia, places that didn't previously have as much attention are now getting a lot more attention because everybody's welcome there.
Yeah.
So if I look at that from the Xanadu story, in 2022 we had a big project. It was in Mongolia. It had a scoping study, and we were talking to everyone about how do we fund this. The majors said that's a great project. We love it technically. We love it commercially. We can't get our head around Mongolia. Mongolia scares us. Our board's got restrictions on where we can invest. It's outside our risk profile. And we went through that sort of jurisdiction was the real headwind. Until there was a presentation with the Mongolian and the Chinese premier saying we're going to do business together, and all of a sudden Zijin comes in and says, we'd love to do a JV with you. Gave us a deal that was basically what we were asking for. And as far as I can tell, they didn't even have a project development team for early stage work. They said, you run the PFS, we'll come back to you when you finish it, and we'll talk to you more. And it was really clear this was a strategic M&A. This was, yes, the project fit their portfolio well, but all of their investments were in operating assets. That's what they like to do. That's what they're good at. They buy something, they expand it, and they go on and do another deal and another deal and another deal. We went through the process where the government was scrutinizing it, but the Mongolian government was happy, and the Australian government said it's in Mongolia. We're not worried about it. And fast forward now, then you take that and you fast forward it till 18 months later, the pre-feasibility study's done. And we go back to some of these same companies and say, all right, we still own half of this project, we need to fund our share. And those I'm calling them Western companies that said they couldn't get their head around Mongolia, at least 4 or 5 of them, and we're talking majors, would tell us, actually, we can look at Mongolia now. We've adjusted our risk profile. There's demand out there for these projects. We have to look at places like this. Asian companies were more aggressive, and Zijin figured they had their foot on it, so they said, we'll come back to you. We'll play hardball with you for a little bit. And so you saw the relaxation of the risk tolerances. Ultimately, these same Western companies couldn't get their head around a deal with Zijin at 50% ownership, but we were able to create tension and competition because of this global trend you were seeing, where Asian companies were also looking for a place to invest. They were cashed up. The gold price was running, and ended up doing that deal away from Zijin. So all these trends, we really saw geopolitics driving the entire deal.
Thanks, Spencer. It's interesting how this competition and the risk profiles are changing, and Western companies are looking at other areas that they weren't looking at before. I got a last question here. I'm going to come back to Karina just on this very topic on geopolitical tension, and your perspective will be obviously different than others on the panel, because your practice takes you all around the world doing deals with lots of different clients. How do you see this geopolitical competition playing out for M&A?
So I'll just make 2 points in addition to what Spencer has already said. And one is there's lots of capital being deployed, at least on paper, by governments into the sector, driven obviously by geopolitical competition. But there's only one sovereign, I think, in the world today that actually has a long-term strategy around this, and this is China. Right? Everybody else is just playing amateur dodgeball, so throwing money at things that are either proximate or visible or they make headlines. Whereas China has taken a very long-term view, and as a consequence of that, has consolidated the majority of rare earth processing and therefore is controlling that market, is controlling the lithium market through subsidies throughout the value chain, and you can see that every time that a Chinese mine, a lepidolite mine goes off stream, the lithium price jumps, and the reaction is immediate. So it's not even the processing control, which China does have in lithium, but the fact that they can, through subsidies, force mines or push mines to turn on and off, thereby impacting the price in a very real way. They have a substantial share of the copper smelting market, which has driven the rest of global copper smelters into a complete disarray with negative TCRCs over the past couple of years. And I think we'll continue to see that. And that is very much about subsidizing through the value chain. It's about supporting national champions that are going out and putting their foot on resources globally, and subsidizing processing and concentrating that in China. I don't think anybody else comes close to having that type of control and long-term strategy. And then the second point I'll make is that Chinese players are progressively being locked out of both certain regions where they're just not welcome, which forces them into a smaller number of jurisdictions, which in turn has an impact on the prices and the valuations the Chinese players are willing to pay for assets in areas of the world that are still accessible to them. And then secondly, they're being locked out of certain projects. So for example, if the US is funding a copper development in some way, there's a very clear directive to the sponsors of that project that Chinese equity ownership and sales into China are not welcomed as part of that package.
Thank you, Karina. Thank you to all the panelists. That was a great conversation on M&A today. I know we're out of time.